good afternoon, good morning and good evening, whenever you happen to be watching this video. Welcome back to the Fit Finance Sessions. For once, actually, for quite a long time, I believe, we've actually got all three musketeers in the same room. So I'm joined today by both Henry Ellison and Tom Senegals. Today we've got a mixture of interesting topics to share with you all, some market related and some more legislative. I can't say the word. Legislative. On that cracking start, Henry, do you want to fire away with some of the snapshots that you've got to share with everybody this week?
Yeah. Well, I'm just going through the Sunday papers, as is my norm, that I pick up for free with my Waitrose card. And two things came to light. The first is something that we've sort of known is going to be happening for a while, but it's never actually been formally legislated for. And that is that the state pension age, we know, goes up over time, and it's always been insinuated that the earliest age that you can draw on your personal pension benefits would be 10 years behind the state pension age. But as I say, there was no legislation in place, but the government has now changed this. So from 2028, the earliest age that you'll be able to draw rights from your pension will now increase from 55 to 57. So it's an important part certainly for us to acknowledge, because a lot of the plans that we will have drawn may well have taken this into account, and certainly for those people who are hoping to retire a little bit earlier, it now means that they may still be able to retire at 55, but they're going to have to make sure that they've got other assets held outside of their pension, so in ISAs or unit trusts or wherever, to support them for those 2 years that perhaps they might have been thinking that they're going to draw from their pensions. So that's just a little point that tickled my fancy. The other thing, going right to the other end of the spectrum, is in relation to child trust funds. So these things were set up back in 2005 by Gordon Brown, the then Chancellor of the Exchequer, and ultimately what they were was that they were just little savings vehicles, whereby I think the government gave you £250 to set yourself up, and then away you went, and the pot of money was typically invested, and there were a few different companies that arranged these things. Foresters was one of them, was one that I quite commonly come across. So the money just sits there as invested and grows, and then by the child turns 18, they're free to access this money. And of course, you as a parent were also free to add into it. These things went much the same way as sort of like the stakeholder pension, and they were quite expensive to operate. And a recent study done by the Sunday Times showed that the average cost of running these funds runs at over 1.5%, which is quite significant. If we compare that to some of the investments that we run and manage, I mean, they run from 0.22% up to maybe 0.75% for the funds and the operating charges. So they're really quite an expensive thing. And then subsequently, of course, they then introduced the junior ISAs, which work in much the same way as the standard ISAs, the standard adult ISAs that we have. But significantly, at the last budget, Rishi increased the amount that you can put into a junior ISA now to £9,000. So for any of you who have still got children with child trust funds, it's well worth having a look at them, seeing how they're invested. Are they doing well or not? How much are you paying? And is it worthwhile transferring them into something like a junior ISA, where you can now whack in £9,000, which makes for a pretty £9,000 a year, which potentially makes quite a nice little nest egg for your little Jimmy or Jane. So there we go. Those are my wise bon mot for the week.
I think the investment options in the child trust funds that were set up were quite limited, and the ones I've seen, there's a few that have done actually quite well, but there's a lot that don't really perform all that well altogether, and there isn't a lot of other options to use within the structure. So the junior ISA is a far better structure in terms of being able to access investments that are better designed for the future, and easy to convert them into full adult ISAs later on. So yeah, particularly with the new allowance, they're definitely something worth looking at.
Going back to your to the pension point, Henry, it's interesting, isn't it? Obviously, pensions as a topic on the whole have been on the list of potential things to be attacked on. God knows how many budgets one cares to remember. So perhaps this sort of slight tinkering with it, with the rules, is the beginning of more of a wider spread door to be opened with changing the rules surrounding the other aspects of pensions. Who knows?
Yeah. And we were talking about it a little bit last week, weren't we, Tom? But who knows what Dishy Rishi's going to do this this budget? Well, I think it's in October, isn't it? But we've spoken about it before. Flat rate tax relief perhaps on pensions down to 30%, or I mean, I suspect that they won't reduce the annual allowance, but perhaps the lifetime allowance gets pulled down, something along those lines. It seems like an obvious place to tinker with, given that he's got to try and raise whatever it is, 250 billion or something to fill this black hole, this COVID-caused black hole in our public finances.
The thing is, though, actually increasing the minimum age actually delays when the government would get any potential income tax from any payment. So it's a bit counterproductive in my eyes. They'd be better off just keeping it where it is, and from their benefit, take the benefits earlier and effectively start to get more income tax earlier than what they would have done. Because I think there is maybe they have been trying to move towards a no tax relief up front, but tax free when you take it out, much like the ISA, because the government gets all their tax now rather than 40 years later in retirement, depending on how long you've got to go until retirement. But I think as well, it just moves in line with state pension, doesn't it? So it's bound to get further and further away, and is probably part of the measures of maybe reducing the triple lock down to a double lock. But we'll wait and see. I guess market-wise this week as well, we've seen a sell-off in tech stocks in the US. I think that train had been going full speed for quite some time, so that doesn't mean it's disappeared altogether, but I think it's interesting seeing I mean, we're up at 3,500 on the S&P, so even before coronavirus, that's an all-time high. Some of that's come off, and money's flowing into other areas like European equity. So whether the bubbles burst in the US, it's been a long time coming. It's not really a bang, it's maybe a letting air out of the balloon, so to speak. But yeah, it's definitely interesting.
How does that sound, Tom?
Huh?
How does that sound?
Yeah, any sound effects that we have are views of our own and not that of
Other sound effects are available.
Yeah, nothing major. I think it's just you just seen a bit more volatility. FTSE's fallen, US dollar's weakening a bit, and that's because of the FTSE 100. A lot of their money's earned in dollars. That's kind of hurt it a bit, but should be okay for domestics. I think you were going to touch a bit more on currency and other bits, weren't you, Tim?
Yeah, predominantly on cable. So pound against the US dollar. So an interesting statistic really that's driving the majority of the falls in the sterling. So just in summary, really, that the UK pound has been rising quite nicely over the last 8 weeks, but now it's retreating quite heavily at the top of it, mainly from the B word. Obviously, I think this year it's become fairly evident that people have forgotten that Brexit still isn't actually done per se, but obviously towards the end of this year is when it's scheduled to crystallise. But actually, an interesting statistic I was reading actually on Reuters was from the Times, only 30 to 40% of senior government officials see a chance that a deal will actually come through. So, quite comfortably less than half of them see a deal happening, mainly due to the state aid sort of contradiction, if you like, or obviously the impasse that surrounds that. But that's mainly obviously clearly then pulling confidence out of the pound, and people are selling it. People are selling off. So interesting stuff. But more interesting, more so than the sterling falling, actually, I find is the lack of confidence that the officials have in the process and what the actual outcome is going to be. So interesting stuff.
Yeah, I think it's funny because a lot of people are talking about the dollar becoming weaker, but actually it's only the euro that it's really strengthening compared to other currencies. I think most are still within similar ranges, aren't they?
Yeah, nothing's sort of bouncing to all-time highs or falling to converted to the other side massively. It's, as you said, much the same sort of volatility type news. But as I said, sterling has been on quite a nice bull run for a little while, from the dollar weakening predominantly. That's sort of the next source of, obviously, when currencies devalue, other things must increase in value because cash must be converted into a different type of currency from selling one to the other. So that's my point, if you like. That I found most interesting.
I think that's the thing to kind of always think about in these sort of times when no one really knows what's going to outperform. You could argue with hindsight, tech and those stocks will do well, but I mean, that's always the story for tech because it's always based on the future. It's just how expensive you pay for it. But if you stay diversified across lots of asset classes, then you're going to be able to ride out pretty much any storm. You might not always get the best performance, but you're also not going to get the worst performance either. And I think those who've been heavy in one area, it looks really good for a period of time, but then it doesn't always look great in any weather. That's just the key thing going forward, I think, particularly as we come to, there's still plenty of stimulus, but I think going into the winter, Brexit, other things, there's nothing to necessarily worry about. I think a lot of it's always made out to be worse than it is, and actually generally things are more positive than it gets made out to be on the news. But equally, just don't put all your eggs in one basket.
Yeah, for sure. I've had quite a few conversations with clients recently of those who are exposed in one particular area. If you're seeing the more highly concentrated you are, the bigger the swings in value that you're going to see each year. And actually, when it comes to retirement, as soon as you sort of translate that to people and say, well, look, that performance-wise, you may have a great time of it and outperform these diversified approaches, which we continue to rattle on about. But actually, when you come into talk about using that money as a source of income and drawing from it, if the value of that pot which you're trying to draw from is doing this, by and large, that's extremely hard to plan with and use to actually create some sort of plan for the future when quite frankly, we have no idea what the values can be in 1, let alone 5 years. And most people tend to sort of, I can understand why you need a bit more of a consistent, yet less exciting and sexy approach to the diversification.
More Skoda, less Ferrari.
Indeed. Yeah. Diesel rather than B12s.
I think that's it for me, unless you chaps got anything else to add.
Not particularly, not this week, I'm afraid.
No more interesting facts for me. Cool, excellent. Well, let's bring it to a close then. And as ever, if you've got any comments you'd like to make, please drop them in the box below, and we'd love to answer any questions that you might have in next week's podcast. But until then, goodbye.